Hi, everybody. Thanks for joining our webinar. Today, John Calverley and I are going to be speaking about FX markets. The topic is elections and rate moves loom. So without further ado, John, I'm handing over to you.
Okay, thanks, Gerry. Let's go to the first slide. So this is just an outline of what we're talking about today. I want to explain why we think the dollar is strong, reflecting relative interest rates, essentially. No big surprise, but I want to look into that in more detail. Then I'm going to argue that we expect it to weaken, really for two reasons. First, because we think the US economy will be slower and other economies will do better than is currently expected by the markets. So it's a relative growth story. And also because we think wage inflation in particular will slow more in the US than in Europe, or more quickly in the US than Europe. And as I'll argue, wages are really key to the outlook at the moment. And that applies to the US, Europe, UK, and Japan for different reasons. Then we'll switch a bit and talk about the elections, and I will argue that net, a Trump win could weaken the US dollar. And then in the UK, we think a Labour win is perhaps mildly bad for the pound, but obviously it's already anticipated to a large degree. And then I'll turn over to Gerry to look at the charts and tell us what they're telling us. Next slide, please. So this is looking at the real effective exchange rate from the Bank for International Settlements. I always start with this and with other related charts because I think you need to know where the exchange rate is fundamentally at the moment. Is it weak? Is it strong? Is it about average? And generally speaking, I come out that the dollar is strong. That means the euro is relatively weak. So you can look at this chart. You can see that back in 2000, when the US was doing extremely well, a strong stock market, strong economy, and the euro was weak, then it recovered. Euro was particularly weak again in 2013, 2014. That was the worst of the euro crisis. And it's come back up, but it's still in the low half of the long-term range. So I interpret this as saying that actually the euro is relatively on the weak side at the moment, a bit below its kind of long-run equilibrium. The next slide. Looking at Japan, I mean, this chart just keeps on going down with periodic reversals, partial reversals. What I think is going on here to some extent is that it's not taking full account of productivity trends. So I think productivity is stronger in the US. And so that means that the yen hasn't become so much more competitive as this would suggest. It suggests it's become twice as competitive. Nevertheless, if you look at what's happened since 2019, the yen's lost about 30% on this, just as it has on the exchange rate. And that, I think, really supports the idea that the yen is in a really weak place at the moment. And next chart. Finally, the pound. Pound's quite interesting. It was very strong around the turn of the century. That was a period with pretty strong growth in the UK, strong productivity growth. Then it collapsed with the global financial crisis when the British financial system was in deep trouble. Picked up before the Brexit vote and then collapsed with the Brexit, and more recently has picked up a little bit. So again, it's in the low end of the range, I would say. Now, Brexit may have changed the outlook. I think it probably did. It's likely that the pound is going to persist at lower levels than it used to be. Nevertheless, I still see that it is essentially undervalued, below equilibrium at the current rates. Next slide. So I'm going to argue that interest rates and bond yields are what drives the exchange rates to a large degree. Not the only thing. Obviously, in the background, what's happening to trade, current accounts can matter as well. Politics, as we'll talk about later, and also productivity trends. So I'm just showing here 2 or 3 slides on the relationship between the 10-year bond yield and the exchange rates. So here, the green line is the Eurozone 10-year yield less the US yield. And the blue line is the exchange rate. You can see there's a broad movement together, although there are some significant divergences. Right at the very beginning of the euro, it was very strong back in 1999. I think that was, cheering on this new currency to a degree, even though the bond yields were going the other way. They would suggest that it shouldn't have been supported. But then they stay pretty close together until we get to around 2012, 2013, when the euro is weaker than would be suggested by bond yields. You see that divergence there. And again, in 2017, the euro is particularly weak, when actually you would have thought that interest rates would support it. But I think you can see there's a general trend here. Let's go to the next chart. Here again for the yen, probably a closer fit really. You can see that it doesn't always work. Again, around the year 2000, it's diverged. The US was particularly, sorry, the yen was particularly strong. Currently, the lines are drawn apart, but they are going in the same direction. So again, I think what's driving the yen is very much relative interest rates. And the next slide. Again, you can see the tendency for these two lines to go together. But the pound at the moment is staying weak despite the pound's interest rates going up. Bond yields are almost the same level now in the UK and the US. And that's not really reflected very much in the exchange rate. So it's been rather slow to come up so far. Next slide. So let's look at the fundamentals of the economies a bit. This is just showing GDP starting in the fourth quarter of 2019, making that 100, and looking at how GDP has evolved since then. And very strikingly, the US is way out ahead of the other two. US has been growing strongly, particularly last year. It recovered earlier, of course, from COVID and is growing stronger, whereas the Eurozone and the UK have essentially been flat now for a couple of years, up and down a little bit. Technical recessions here and there, sometimes revised away, but basically flat. US is doing well, partly because of productivity growth, and partly because of labor force growth. In the UK, we've got this problem that there's fewer people working than there were in 2019, or just about the same now, but it hasn't increased as you'd expect. And in Europe, very low productivity growth. So the US has really been doing exceptionally well. Next slide, please. Where are we going next? Well, this is the leading indicators index, putting together 10 different indicators which tend to move before the rest of the economy. It's been pointing down for a long time now. And this is one of the reasons why economists have been continually forecasting a recession in the US, which obviously hasn't happened. The conference board, where this comes from, have now backed away from a recession forecast, as have almost all economists now, I would say. Nevertheless, it is still pointing towards weakness, at least to some degree. And if we look at the next slide, so this is looking at the purchasing managers indices, the services and the manufacturing index. And you can see they've both come down quite a lot over the last couple of years, stabilized with the manufacturing below 50. So that means the manufacturing sector is still contracting, and the services sector just above the 50 mark. So this is suggesting a relatively slow economy. Which is therefore slightly baffling that we keep seeing these very strong GDP numbers. If we go to the next slide, and I think this is a big part of the reason. The US consumers accumulated massive savings back in 2020. They got that because they couldn't spend, couldn't go out, they weren't allowed to go out, or later on they didn't particularly want to go out and spend. And at the same time, the government was showering them with money in the form of stimulus checks, enhanced unemployment benefits, special loans, etc. And people have been gradually working that down ever since. This measure, there's different ways to measure it. And this is looking simply at household deposits as a percent of GDP. You can see it's come down. It's still not quite come down to where it was. Most estimates suggest that it should be coming down very soon. Sometime this year, probably during the first half, essentially the excess cash will be spent. We know that for poorer Americans, they've already spent it, and they've already worked up their credit card debt back to where it was before. Better off Americans are still in a better place, probably still have some cash, and obviously with house prices strong and with stock markets strong, they've got that as well. Nevertheless, the excess cash is dwindling, and I think this points to a slowdown in spending as we go forward. And essentially, it will show up as a rise in the personal savings rate, which is currently quite low. Next slide, please. So let's turn to inflation, which is obviously critical for where interest rates go. It's what the central banks are watching. And as you can see, it's coming down. There's some signs of stickiness more recently. That applies in the UK and the US. You can see it's flattened out a bit. So the first part down was pretty precipitous, and now it looks like it may have flattened out a bit. The other thing I would emphasize on this chart is you can see the US peaked first. It peaked at least 6 months before the other two countries. And I think that's important because it's basically reinforcing that the US cycle is moving ahead of the UK and the Eurozone. Let's go to the next slide. Now, I mentioned at the beginning that wage growth is critical to what's happening. And that's because when you look at inflation, some of it is obviously food and energy. Some of it is transitory factors that went up for a while due to shortages, due to the supply chain disruptions, due to the strong demand for services and not enough labor. They couldn't hire enough labor to begin with. We've also still got some strange things going on with used car prices, which have stayed up, and new car prices are quite strong because there's still a backlog for cars. So all those things will eventually normalize, and then the inflation we're left with is going to be really what's driven by wages, because that feeds fairly directly into services. So I think the central banks are very much concentrating on what happens to wage growth. And if you can see, this is two different measures of wage growth. The Atlanta Fed wage tracker is generally thought to be one of the best, and that's about 5% at the moment. And the average hourly earnings have come down as well, but they're still somewhat elevated. Now, our view is that actually wage growth in the US will slow fairly quickly over the next 6 to 9 months. And that's because we think the US market is very dynamic, very open, and it tends to adjust quickly. Let's look at the next slide. So this is just one measure of what's going on in the labor market. It's the number of job openings as a percent of total payrolls. So it really jumped up after COVID when people were desperate to find labor. And it's come down and is back more or less on the trend. And we could look at other measures like the quit rate, for example, and see that people are no longer quitting at a particularly high rate. So the labor market has come back much more to normal. And although unemployment has only risen a tick, it just actually ticked up in last week, I think the labor market has returned to a more normal level, which will mean that wage growth continues to slow down. And the next slide, please. So this is a contrast with the Eurozone. This is one measure, the hourly earnings in manufacturing, still strong. And I think this is a problem for the ECB. They've got inflation down reasonably low. It's lower than the US, but they are worried that if wage growth doesn't come down as well, then the inflation will not go all the way down to 2%. So they're looking at this very closely. Obviously, interest rates are not as high in Europe anyway, but I think they feel that they need to see more progress on wages before they're willing to cut interest rates. And the next slide. Similar picture in the UK. You can see the average total weekly earnings was over 8% quite recently. That's thought to be a bit of an anomaly, and this figure around 6, just under 6, is probably more reasonable. But you can see that it's still too high. Productivity growth in the UK is low. And this needs to go down at least to 4%, probably to 3%. So there's more to do in terms of bringing wage growth down in the UK. Brexit doesn't help because Brexit makes things generally less competitive. So it's easier to pay higher wages to people, and it's harder to get new labor. So I think it's going to be harder to get wage growth down in the UK as well as Europe in comparison with the US. So let's go to the next slide. So this is just a reminder of where we are. We've been basically on hold now for, what is it, about 8 months, I suppose, something like that. Expectations for rate cuts are in the markets. We go to the next slide. We can see this is the implied futures curve. The red line is where we are now, and the blue lines are 3 months ago. So you can see expectations for rate cuts have been dialed back quite a bit over the last 3 months. And that's partly because of what the central banks are saying. They're saying we're cautious, we don't want to move too soon, but also because some of the economic growth numbers have been stronger than expected, and also some of the inflation numbers have been stickier than expected. But still, the markets are expecting rates to go down. And I think exactly how this plays out is going to be critical to the exchange rates. Our expectation is that the US will cut rates this year. The chances of a June rate cut, I think, are actually receding at the moment, although that's still a possibility. We will need to see some better inflation numbers by then, and also probably some weaker growth numbers. Why else would the Fed cut if economic growth is still bounding along at 2.5% or more, and if inflation is looking a little bit sticky, then I don't think they're going to be cutting. The same largely goes for Europe and the UK, where, as I said, wage growth looks stickier than in the US. And also, we're starting to see signs of a pickup. Certainly in the UK, the economy's been weak. Looks like the first quarter will be positive, perhaps quite strongly positive. And Europe as well could see some of that. The reason here is, again, linked to wages, because wage growth is relatively strong, and because headline inflation has fallen because energy prices have come off. So consumers have a lot of money to spend now. And that, coupled with an improvement in confidence, is tending to lift the European economies. So the way exchange rates works out is going to depend a lot on when and how much they cut. And our expectation is that US is going to cut more and faster than Europe and the UK because of this differential in wage growth. Let's go to the next slide. Yes, just briefly on Japan. So again, wages are critical in Japan too. This chart is not wage growth, it's wage level. So you can see we're only just above the level of 1991, 30 years ago. But wages are rising now, and there's been reports of some quite big settlements, Toyota last week, for example. We don't know the numbers on that, but there are signs that finally the message is getting through to business that they can and should pay higher wages, and it's beginning to happen. And that is expected to be the signal for the Bank of Japan to take rates above zero, or at least to zero, or probably just above zero, either next week or the meeting after. Now, of course, it's not going to rise rapidly. I think what the yen is going to be pushed more by what happens to US rates than what happens to Japanese rates, because Japanese rates are going to go up very, very slowly. But I think the beginning of a rate rise puts them on a new path, and that will support the yen over time. Next slide. So turning to the politics, we now know that Trump and Biden are the candidates. That's pretty much established. There wasn't much doubt about it anyway, but that does seem to be the case. So I would say at the moment, although the betting is slightly in favor of Trump, I would say most people are probably looking at this as still wide open. There's such a long way to go still. So what would a Trump win mean for the US dollar? And it's a difficult one to call because there are different factors here. First of all, his policy to raise tariffs, particularly if he raises them other than China. He has talked about a general tariff on all goods, 10% tariff. That would tend to boost the US dollar. And if you think about it from the European perspective, suddenly you've got to pay that, or Europe has to pay that extra 10% to get its goods into the US. Instinctively, the euro would tend to fall. That could be offset, though, if Europe responds with a 10% tariff, which will be a really bad outcome. I mean, this whole policy is criminal, in my view. It's a bit like the 1930s and the Smoot-Hawley tariffs, which were a major factor in the world depression. But if he does that, if he does raise tariffs, it probably will boost the dollar a little bit. If he leaves, if Trump decides he definitely is leaving NATO, I think that would undermine the euro to some extent. International investors would look at Europe and they'd say, well, you know, it isn't tied into the US so strongly, doesn't have such a strong defense position. That's mildly negative. I personally don't think he will do that. I think it's a threat, but obviously that threat is enough to affect the currency. On the fiscal side, fiscal deficits can play a big role. I think what we'll see with the Trump presidency is that it'll be driven by tax cuts. So you'll have a deficit and it'll be driven by tax cuts or the extension of the old tax cuts, which expire next year. Whereas with Biden, what you've got is high spending. So you're going to get a deficit either way, which is bad news. But with Trump, it's going to be more because of tax cuts, and with Biden, it's going to be more because of higher spending. Overall, though, that's pretty neutral. I think we'll just stay with a large deficit. But then coming back to tariffs, they will obviously raise US inflation, and that will slow the economy. So that's actually negative for the dollar. Another issue is maybe the US dollar safe haven status could be damaged. And this is partly about the volatility and uncertainty of Trump policies, but also about his attitude towards NATO. And finally, I think Trump has made it clear that he likes a weak dollar. He thinks that's good for his sort of blue-collar manufacturing base. And so that's negative. He's inclined often to talk down the dollar, and that can play a role. So net, I think this comes out negative. You can argue it the other way. Some people think that the tariffs are an overwhelming factor that will push the dollar up. But I think net, because of the uncertainty, the volatility, the poor economic policy, and the uncertain international policy, I think it's a net negative. And the next slide. What about in the UK? Well, obviously Labour is widely expected to win. I guess there's a slight question as to whether it wins with an absolute majority or not. But with the problems for the SNP in Scotland, more likely that they will win with an absolute majority. Labour now is much more like the Blair-Brown project under Keir Starmer than it was under Jeremy Corbyn. So it's become a much more centrist, more responsible party. Frankly, after the Liz Truss prime ministership, I think both parties are fiscally cautious. They don't want to see another blowout in bonds and the currency. However, I do think that Labour policies are mildly negative for sterling. They will tend to, I think, spend more and tax more. Now, they have said they won't raise lots of individual taxes, but I think they'll find ways to increase other taxes somehow. And the other point I would make is that I think some of the changes that Labour is proposing on the labour market are quite radically reversing many of the measures that were taken in the 80s by the Thatcher government to liberalise the labour market. And that will make it a less attractive business environment. That means less foreign investment, and that's bad news. Having said all this, because Labour is already widely expected to win, I don't think the British election is going to play such a big role in the currency markets as the US election. Okay, next slide. And it's over to you, Gerry.
Thanks, John. There's a lot to unpack in your presentation, but I think I'll give an overview of the charts and we can come back to some questions if that's okay. So, hi everybody. These are our forecasts that we publish every month. And the key thing to take away from all these numbers is one, we expect the dollar to soften pretty much across the board. We expect the yen to firm, and we're actually looking for the euro Swiss to potentially base, which is a huge reversal of what happened last year. And in commodity effects sphere, there's so many conflicting winds going through these currencies, but overall, we expect some of them to firm. But if the dollar loses ground, they could actually firm quite a lot against the dollar. However, on the yen cross rates, they may come under pressure. And that's one of the strange things about the foreign exchange market is that sometimes you have Aussie yen beating up on Aussie dollar, if you know what I mean. So even if the Aussie dollar may be trying to firm, if dollar yen is falling a lot, then Aussie yen gets caught up in the whole maelstrom. And next thing you know, the Aussie's losing ground because Aussie yen selling is basically dominating FX activity. What we do in these forecasts is we say, here's current spot, here's the current forward, here's our forecast, and how much we expect it to swing around. The key takeaway, again, one of the many key takeaways is we're looking for the yen to firm around 15, 16% against the dollar over the next year, which is a hefty move. And that actually translates through a lot of the cross rates. And we're expecting the Swissy to lose ground against the euro by a similar amount over the next 12 months, which again is shocking to anybody who's thinking we'll never see parity or higher in the euro-Swiss cross, but is actually quite significant for anybody who's holding Swissies or yen as part of any sort of carry trade. All of a sudden, you may want to be thinking about which one you actually want to sell to fund the trade. And instead of yen, maybe think Swissy. So let's get on with the charts, John. Okay, I need to click on it. And away we go. The first one is euro dollar. Now, this is a long-term chart, which, I'm not going to talk too much about it, but what I usually do is I run a 12-month moving average, that's the red one, and then I use a 5-year moving average, that's a blue one. That kind of tells us more or less where we're going and where we've been is probably the best way to put it. And as you can see, the euro dollar's had a wide range from roughly above 80, 0.8, all the way up to 1.6. So it's one of those things where we've got a pretty well-established range ever since the euro's been in existence. And our view at the moment goes back to what John and I have talked about in our podcast, which is currencies trade, in our view, on a rubber band for the most part. Now, sometimes the rubber band snaps. Usually we see that in emerging market currencies where they can go in a solid trend for a while, a lot longer than people expect, and for a lot more of a move. However, in the major currencies, usually we think they trade in a rather broad range and they work towards targets as economic fundamentals are either leading or coincident or lagging, and people tend to swing their moves around on that. Now, let's bring it down to the now. I was lucky enough to be invited by the STA and ACI to give 2 talks in 2021 on foreign exchange forecasts, and both of them, I stuck to the Tricio view, which is the dollar is going to firm. And the euro dollar, we were looking for the dollar to basically move away from the 120 zone and get down to parity, maybe a little bit below. That happened. And now, ever since late 2022, we've been saying, look, we saw the move. So much of the dollar strength is priced into expectations already that maybe we see a bit of a pullback. And so far, it's been limited in our favor, but not really hitting our targets. Our targets are still a break of 112 on a sustained basis and then higher. What does that look like? Well, here's a shorter term chart, and we expect the euro dollar to return to 120 and 125 over the next 12 months-ish, okay? And the reason I said ish is because that was the same forecast we had in the middle of last year, and it hasn't happened yet. But we're still looking for the dollar to firm. The key takeaway from this chart is, one, it looks like we based. It looks like we based below parity back in 2022, and we've bounced up since then. The current tug of war is horrible because we could be in a broadening triangle. That's the purple lines. Now, the purple lines are a nightmare to trade because basically when it goes up, you think it's going to go up forever, and instead it comes back down. And when it goes down, you think it's going to go down forever, but instead it bounces back up to the mid-range. Now, the moving average on the weekly chart, which is what this is, would be the 13-week moving average, which is the red line, and the 50-week moving average, which is the blue line. Now, what we're looking for at the moment is for attempts for the euro dollar to try to get back above 110 on a sustained basis, then up to the 112 and change area, then up to 115, slowly, working our way up towards 120 target. We know we're going to be wrong if we start breaking below 105 on a sustained basis. That'll put parity and below into perspective again. And we also know that a lot of the market is against us. They think the dollar is going to firm for all the reasons John said about the US economy. The problem is they're not looking forward, like John is, to Fed rate cuts, potentially narrowing of interest rate spreads between European and other bonds and the US bond, and things like that. Because remember, it's a relative trade, not an absolute trade, which is what the FX market leans towards as well. So we think if we start getting above 112 and change in the euro dollar, that may not be the peak, and we may see that move to 115, 120, and 125 instead. Now, these are the gorgeous charts that PowerPoint allows us to use to illustrate our target moves. What about cable? Again, here's a long-term chart first. On the cable chart, you can see that we used to trade above 2 back in the day when the Labor government was in power, I believe, John. So it's one of those things where, just because you have a Labor government doesn't mean your currency can't firm-ish, right? Now, it's one of those things where Brexit, the EU referendum, really hammered sterling. We went from 150, an overnight drop, to 135, 134. And we haven't really come back to 150 since then. So that seems to be acting as a huge cap on sterling hopes. In the near term, though, the Truss government was short-lived, and you saw that spike down to 103.80 and change as a new all-time low for sterling. And since then, we bounced, and we're quite happy with the bounce because we've been looking for it to bounce. However, it hasn't bounced, quote-unquote, enough. So on the technical chart, again, 13-week and 15-week moving averages, we're starting to work higher. We're starting to break trendline resistance. We need to hold above this on pullbacks. You don't want to see cable trading below 125, 123. You want to see it trading above 128.30, 128.60, and starting to break above 130. For our view of a move back to 142 and 144, to actually get some more technical confirmation. Now, we could see, and this is, throwing darts out there, and John and I have talked about this in our podcast before, and you can find our podcast, just Google Tricio Investment Advisors, Spotify, and the podcasts come up. And hopefully they're interesting. But it's one of those things where we're looking for sterling to beat up towards 142, 144, not so much on just pound strength, but as John pointed out, a bit of dollar weakness as well across the board. And again, that was our target. Now, euro sterling. We have to mention this because euro sterling is still one of the major targets. Major spot cross rates. But anybody who trades this for a living has been having a horrible, horrible time for a few years now. Yes, we saw the EU referendum shift, and sterling has been weak since then, or at the weaker end of the historical range, but it hasn't really been able to bounce back. Now, when I look at this chart, I think we can't go down and we can't really go up. So you could make the argument we're going to be gridlocked forever. However, and this is the tricky part, I do think that because we can't really do much below 85 pence, let's say, we are probably going to rotate to the blue line that's falling, which is just above 90 pence. It's not a huge move, but basically it's gradual rotation to the middle of the range, which would be euro strength, and some risk of seeing the top red line approached again, which again would be euro strength and sterling weakness. So this may come through in the cross rates. If we see cable, sterling against a dollar, constrained by the 142, 144 zone, and if I'm wrong about the euro dollar, because remember, we're just looking for a correction in the rubber band from below parity to 120, 125, there should be some risk that the euro dollar could actually turn up towards 130 and maybe a little higher, which would take this cross rate back to the top of the range. Dollar yen. As I said before, this is going to be one of the big swings that we're looking for. And I don't think the market has fully priced this in. Now, this is a monthly chart going back to the 80s, which none of us ever think about. Well, except maybe John. But it's one of those things where, John, you and I were both around in 85, 86, 87, when basically dollar yen started really motoring. And it's one of those things where it pays to look back and say, okay, we think dollar yen is weak now, 150. Or sorry, dollar yen is strong now, 150. But, the rate used to be a lot higher. The world has changed since then, though. And it's one of those things where we stayed below the 125-ish area for so long that I think the market forgot that it could actually go back up. So this is the dollar strength that has come through so well here since we started basing out in 2020, and 2021, the dollar just took off against the yen, or the yen was soft against everybody, if you want to look at it from the market perspective. Now, what we're looking for here is, even though if I go back to the long-term chart, you can see that there is upside risk, which is what we keep saying in our podcast and our currency monthly insights, is we say, look, currency matters, and we saw the move from basically 100 yen to the dollar up to 150, and there's some risk that we press on 160. If we do start breaking above 160, realistically, we have 180 as a potential, area of dollar resistance, but there's not a heck of a lot from there to 200 and even worse. So when we come to the shorter term chart, again, weekly chart, we really think that dollar yen is probably going to top here. Like John said, not because we expect the Bank of Japan to raise rates aggressively for the rest of the year, but just because they're going to make a nominal push away from negative rates. They're one of the, the only central bank, as far as I'm aware, that has negative interest rates at the moment. They're going to potentially change that next week or in April, or surprise the market and change it later in the summer. But we think by April they will do it. And that's going to be the first step of, quote unquote, many small steps as they either remove or reduce the stimulus that they've been providing for the Japanese economy for so long. And that's something the market hasn't seen for many, many years. So in my view, on the technical chart, when I look at this, I say, look, we can't really do much above 150, 152. We seem to be finding yen buyers up there, with the prodding from the MOF and the BOJ, no doubt. Technically, it looks like we're going to have some downside bias here. And the magic of the arrow is it's pointing towards a move down to 130. Why? Well, you can see the clear bearish divergence in the weekly RSI. That's 14 weeks. We look at this as some sort of sentiment indicator, and basically you haven't been able to push higher for a while in terms of dollar terms. And if the yen does manage to firm below that rising orange line, which is just above 145 now, then it's one of those things where we'd be very, very happy to look for a move down to that slightly rising purple line near 130. Now, things get interesting there because the last time around, we had a lot of frenetic activity between 130 and 126 and change, which is where we made the low back in early 2023 when we were motoring down as the dollar corrected. Now, it's one of those things where if we start breaking below the 126, give it to 125, then I think you're going to see a lot of momentum traders, hedge funds, currency allocators, currency traders, and basic hedgers start thinking, okay, what if we return back to where we were a couple of years ago? Again, we're still in the rubber band area. So it's going to be, you could easily see, in my view, the risk of 120 becoming 115 or even 110, which seems like a huge move now and nobody's expecting it, but it's not outside the realms of possibilities to see the dollar lose that much ground against the yen once a trend gets established. Now, if you see dollar yen moving that much, then you've got to be thinking that euro yen will have some downside risk as well. And the magic arrow comes in, and just if euro yen does top out where we are now, then you could see a double top pattern forming. You're going to see euro yen falling below. Again, the red line is the 13-week moving average, and the blue line is the 50-week moving average. You're going to see euro yen breaking technical levels, which should trigger more, like I said, hedgers, spot traders, momentum traders, CTAs, hedge funds, everybody looking at maybe a move down to 135, driving the cross rate. Now, the key thing here is, once again, if euro yen starts moving that aggressively, that could temper euro dollar upside in the short term and weekly trading, because euro yen can sometimes, or it seems to, have an impact on euro dollar. So it's one of those things where you have to keep an eye on the different cross rate flows, and you have to be aware that once the yen starts trending, it's a very trendy currency. It can carry it a little bit further than quote unquote we expect. In other words, the rubber band can extend both ways. Now, what happens if we start breaking significantly above the 165 area? Well, again, it's one of those things where you'd have to be thinking about 170, 175 risk on the view that the yen is a trendy currency. And if it is falling sharply again, then it's going to carry on a few more percentage than we would normally expect. Now, I mentioned Euro Swiss, and this is one of those key things where, quote unquote, not that many shops trade Euro Swiss for a living, but it's one of those factors that is always worth keeping in mind. Now, this is a long-term chart, and it shows the S&P 2015 shock of not holding the floor at 120, and it shows the consolidation we've seen in the market since then, within a relatively broad range. Now, what we saw last year was the Swiss National Bank essentially tolerating a stronger Swiss franc. They seem to be reversing that. They haven't really explicitly said they want a huge up move in Euro Swiss, but they have said that they don't think a strong Swiss works well for their inflation targeting. So let's see what happens now. I'm looking for a move above the blue line, which is the 50-week moving average, and looking for a move back to parity, which we haven't seen in a while, and then up to the red line, which is above 105. And it seems to mark an area where the cross rate sort of bounces, either a support or resistance, and it seems to be like a natural attractor. So I'm looking for Euro Swiss to bounce up towards there, potentially extend a bit up to the 110, maybe 115 area before it starts finding some natural sellers. That's a relatively brave call, because it was just a few weeks ago that we were actually breaking below key chart support and looking at the abyss, if you're looking at Euro Swiss, from the view that a strong Swiss franc doesn't really help that many people if it persists. There's our target. Like I said, it's a relatively aggressive move, so I would say that the Swiss call and the yen call are the big ones for us. Dollar Swiss, that's a tough one, because if the dollar weakens across the board, as we're looking for, then you could argue for dollar Swiss to soften a lot further. Here again, it's one of those ones where the cross rate is so important. So if Euro Swiss does start breaking higher on a weaker Swiss franc, then dollar Swiss may be dragged along a little bit higher, which is what we sort of expect to happen. We're not looking for a huge move back to parity, but we are saying dollar Swiss may have set the floor already, and it may just consolidate a touch higher over the course of the year. Commodity currencies. Now, in the straight Aussie dollar, we think it's based, and we're looking for a move up to the top, the blue line that's falling. So that's going to put us above 70. Okay, fine. And there is some risk that we actually see a breakout towards 75, or we've traded before not so long ago. So it's one of those things where we're looking for the Aussie dollar to consolidate within a broad range that's been established since COVID and move up towards basically the top part of the range. Again, you have to temper that view with Aussie yen, because if the yen does start firming a lot, then the Aussie may come under pressure. Kiwi, same idea. It's one of those things where we see the risk of Kiwi dollar going up, basically in a breaking out of the top of the near-term range and pushing back up towards where we were just after the COVID bounce in the Kiwi. So it's one of those things where we're looking for a recovery in the Kiwi. We're not looking for an aggressive move higher, and it has to be tempered with the view that if Kiwi yen starts falling sharply, then Kiwi dollar may not rise as fast as we expect it to. Dollar Canada. Again, it's been consolidating in a range for a few years now, but the purple range, which is just above 140, 138 to 140, that seems to be drawing out Canada buyers. So we're looking for the dollar to lose ground towards the broad red line where you've seen dollar Canada find resistance and some support in the past, and that'll put us just below 130. That's really a boring forecast. However, our view is that we start breaking below there, then we could see dollar Canada shifting a little bit lower towards the 125 area, and there should be some risk of seeing 120. So that's a bit of a weaker dollar and a stronger Canada, which should unfold over the next 12 months, down to there. Now, here's where we get tricky, or we don't want to get too far into the weeds on China policy, but it's one of those things where it's one of the more traded currencies in the interbank market now, and it does kind of drive everything else. However, remember, it is a dirty float. It's basket currency. The Central Bank of China, People's Bank of China, does control a lot of the daily FX in terms of what they allow it to move. We all know that. However, when I look at this chart, I think it's based, and I think there's going to be significant risk that we break above the 7.3 area, and I look towards 7.5 and 7.8 as the next targets up there. Now, what does that mean against other currencies? Well, the yen has been getting away with murder, if you want to put it in currency terms, because the yen has been so soft. So if the CNY starts to weaken a little bit, and if our view on the Japanese yen is correct, then we would be looking for this currency cross rate to correct quite a lot. So that could be interesting for people who can trade the CNY or CNH and look for the yen to maybe gain or regain some ground that's lost over the years. Now, that could actually be a more significant move if we actually see the CNY move towards 7.5 or even towards 7.8 over the next 12 to 24 months. And if dollar yen does come back below 140 towards 120, then the cross rate could actually fly lower, or in this case, dive lower. What about the Korean won? Okay, again, we didn't want to get too much into the weeds, but this has to be explained. Korean won has lagged the yen in terms of weakness. However, against the CNY, the Korean won has been a little bit weaker. What we're expecting here is dollar won to firm a bit. Sorry, the won to firm a little bit against the dollar, and then the won to firm a lot against the CNY. So these two charts, the one on the left is against the dollar, the one on the right is against the CNY, and we're expecting the Korean won to firm on both to those levels. Now, John, that's it for my part of the slides. James couldn't join us today, but he's available to answer questions for anybody who has any questions on hedging or any questions on currency risk management and things like that. As we've said before, both John and I have a lot of experience doing FX market research, and James has a ton of experience doing FX market hedging and using options and other sort of derivative instruments to manage FX risk. John, the only question I have for you is, what happens if Biden wins? Does the dollar firm or does the dollar fall? Or does it matter?
Well, yeah, I mean, presumably Biden winning is continuity. So it's going to depend what people are expecting at that moment. But if you take away the Trump risk, then I suppose it could mean slight dollar firming.
Okay. And the other question is on China, do you see a bias towards a weaker CNY, or do you think they'd rather not let it weaken too much?
I think both. I think they
Okay.
are probably biased towards a weaker CNY, but they don't want to lose control of it. Now they shouldn't really lose control because they have capital controls pretty tight generally. Um, I think they've been reluctant to cut interest rates as much as they would have liked because of the higher rates in the US. So as the US cuts rates, I think we'll see further rate cuts in China. Makes sense because they've got very low inflation. Consumer price inflation is basically zero. And wage growth is not that high, and the economy is quite weak. So I think they're probably okay with continuing mild weakness in the CNY, alongside lower interest rates to help move the economy. They haven't really got much scope for fiscal stimulus. People keep looking to them and saying, "Why don't you do fiscal stimulus?" But the trouble is they've already got far too much government debt. Not so much central government, but the local government. And so ultimately the central government has to stand behind all the local government debt and all the state enterprise debt, and the financial sector ultimately is backed by the government. So they can't afford to have too much debt. So I think that's why they're quite reluctant to use all that much fiscal stimulus. So I think a little bit more monetary stimulus would suit them.
That makes sense, and that's kind of in line with what we talked about before. And the final, I did say final question, but this is the final question, John, is in our Spotify podcasts, and other places to listen to podcasts are available, but in our podcast, you mentioned where you think dollar yen could go on some sort of fair value or PPP basis. Do you still think it's going to be around 120-ish as the where it should be in a purchasing parity sort of idea?
Yeah, that's the kind of number I would pencil in. Yeah, yeah,
Okay,
maybe even a little bit stronger than that, 110 to 120.
that's right. Okay, so for anybody who's listening to this who does or is interested in FX markets, PPP is one way to try to find a fair value for a currency, spot rate or cross rate, and it does take time to work towards it. That's probably the best way to put it, right, John?
Yeah, I mean, in some senses, you don't go to equilibrium because that is kind of an attractor. It's more like it's the middle of where you are. So if we get to that level, chances are we won't stay there. We'll swing right through it. That's what
That's
typically
a hard
happens.
part about currency forecasting because you and
Yeah,
I can sit here and talk about 120, 115, but we both know if it gets there, it might go to 100, in which case we're
exactly.
stuck in the position of saying you got to buy dollars now. And they're saying, but you said sell dollars at 150. And you're saying, well, things have changed.
Yeah. Yeah, well, then you have to ask, well, what's the next direction? How
Yeah.
are interest rates and other factors likely to swing it from there? Over the very long run, you'll probably find it did average out at 110 to 120, but that's by spending half its time at 140 and half at
Yes.
100.
So hedging at the average is very, very difficult and could
Yes,
be very expensive as well. Okay.
yes.
Thank you, John. And we'll end our webinar here. Obviously, if you have questions, you can email us and we're happy to take them on board. And we'll be posting the link to people who registered for the webinar. Thank you, everybody.
Okay, thanks, Jerry. Yeah, bye, everybody.